SBI Cards was once trading close to rupees 1000 per share, but today the stock is around 500 to 600 zone. So if somebody invested rupees 1 lakh near those higher levels, a big part of that value disappeared. But here is the interesting part. Indians did not stop using credit card. SBI Cards did not stop adding customers. Card spending continued increasing and revenue also kept growing. So why did the stock fall so much? The real problem was not that the business stopped growing. The problem was that this growth was becoming less profitable for shareholders. And one number explained this better than almost anything else: ROE, or return on equity. At one stage, SBI Cards was generating more than 20% ROE, but during one of its weakest quarter, ROE fell to just 12.5%. And once you understand why ROE fell, the entire SBI Cards share price story became much easier to understand. First, let us understand how SBI Cards actually makes money. Suppose your credit card bill is 50,000 rupees and you pay only 30,000. The remaining 20,000 is carried forward. And SBI Cards can earn interest on that amount. It also earns money through annual fees, EMI charges, late payment fees, and other card related income. So the model looks simple: give customer credit, customer spends, and SBI Cards earn interest and fees. But there is one major risk. What if the customer does not pay? Suppose SBI Cards earn rupees 15 from a customer through interest and fees, but later loses rupees 10 because that customer defaults. Suddenly that rupees 15 rupees income does not look very attractive. And this is where the credit cost became extremely important. Credit cost basically tells you how much profitability SBI Cards is losing because customers are not repaying properly. So remember this simple chain: more default leads to higher credit losses reduces profit, lower profit reduces ROE, and lower ROE can bring down the valuation of the company or the stock. Now look at SBI Cards before the problem became serious. In FY 2023, the company was doing very well. Receivables, which simply means money customer owed SBI Cards, increased from around 31,281 crores to 40,722 crores. Profit increased from around 1616 crores to 2258 crores, which is roughly 40% growth. Gross NPA was around 2.35%, while ROA, return on asset, was around 5.6%. So investors were looking at SBI Cards as a fast growing and highly profitable financial company. But then customers started becoming more leverage. In simple words, people were taking on more debt. Someone might have to credit card, a personal loan, a phone EMI, and maybe a car loan, while their salary was not increasing at the same speed. Eventually, some customers started struggling to repay, and because credit card lending is unsecured, meaning there is usually no house or car kept as security, default can hurt profitability very quickly. This problem became very visible in FY 2025. In quarter 1 FY 25, gross credit cost reached around 8.5%, and in quarter 2 FY25 it moved close to 9%. Gross NPA also increased to around 3.27%. But here is what makes quarter 2 FY25 so important. Retail spending increased 24% year on year to around 76,398 crore. Receivable increased 23% to around 55,601 crore. Revenue also increased to around 4,556 crore. So if you look only at spending, lending, and revenue, the business appeared healthy. But profit told a completely different story. Profit fell from around 603 crores to 404 crore, a decline of roughly 33%. So SBI card was growing, but the benefit of that growth was not reaching shareholders. Imagine your shop sales rise from 100 rupees to 110, but losses from customer who do not pay you rise from 5 to 15 rupees. Your sales have grown, but your actual profitability has become much worse. That is essentially what investors start seeing in SBI cards. And this brings us back to ROE. In quarter 2 FY25, SBI cards ROE fell to around 12.5%. Just 1 year earlier, it was around 22.3%. Think about what that means. Earlier, for every 100 rupees of average shareholders' capital, SBI card was generating roughly rupees 22 of annualized profit. Then that return fell towards just 12.5 rupees. Would investor pay the same price for both businesses? Obviously not. And this is what people mean when they say a stock has suffered a value derating. The term sounds complicated, but the idea is very simple. Earlier, investors were willing to pay premium price because SBI cards had strong growth and high profitability. Once credit losses increased, profit weakened, and ROE fell, investors were no longer willing to pay the same premium price. So the stock was hit in two ways. First, profitability became weaker. Second, the valuation investors were willing to give the company also fell. When both happens together, a share price can fall sharply even while revenue is still growing. SBI Cards then started trying to fix the problem. Management became more selective about whom it gave credit to, reduced credit limit for riskier customer, improved collection, and focus more on better quality borrowers. By the first half of FY 2025, management said limits had been reduced for around 10 lakh customers. Gradually, the number started improving. By Q4 FY 2026, gross credit cost has fallen to around 7.7%. Gross NPA improved to around 2.41%, and ROE recovered to around 15.6%. Then in Q1 FY 2027, gross NPA improved further to around 2.04%, while ROE moved up to around 16.5%. So, yes, the situation has clearly improved from what the worst part of the cycle, but there is still one big challenge. SBI Cards now has to prove that it can start growing its lending book strongly again without creating another bad loan cycle. If it became too aggressive, defaults could rise again. If it became too conservative, bad loans may improve but growth could remain weak. So from here, I would watch just five numbers every quarter: credit cost, gross NPA, receivables growth, ROA, and most importantly, ROA. The SBI card story is actually very simple. The stock did not fall because Indians stopped using credit cards. Card spending continued growing and the revenue continued growing. The real problem was that too much of that growth was being eaten away by credit losses. Credit cost moved close to 9%. Profitability weakened and ROE fell from 20% level to just 12.5%. Once shareholders' return dropped, investors were no longer willing to give SBI cards the same premium valuation. Now the numbers are improving, but the biggest question is not whether Indian will keep using credit cards. They almost certainly will. The real question is whether SBI cards can grow receivable again, keep bad loans under control, and take ROE back towards 20% or more. Because ultimately, growth alone does not create shareholders' wealth. Profitable growth does. And thanks for watching. As a request, please do subscribe the channel. See you in the next video. Take care. Bye bye.